Pillar one is about this virtual nexus where you don't need a physical presence to be taxable, and a formulary reallocation of profits of very large groups, those with annual sales of more than 20 billion euros and a profit margin greater than 10%. So we're talking about very large, very profitable companies. People think it might be 100 multinationals in total. But they're looking at possibly expanding the scope in the future after, sort of bedding down the rules and how they work. There's a second element to Pillar one that I didn't mention earlier, which is so-called amount B, deemed taxable income from baseline marketing and distribution activities. This is meant to simplify transfer pricing and minimize transfer pricing disputes. We have had no guidance so far about what exactly the amount B terms will be, what the definitions will be, what the deemed taxable income would be. So we're waiting for all that later this year. Another piece of the work on Pillar one mainly for amount A, formulary allocation taxation, is a new multilateral dispute prevention and dispute resolution mechanism, so that companies and countries can get as much certainty up front as possible about who gets to tax what. And so we don't end up with a mess of litigation and disputes between countries over how this new allocation and apportionment actually works. And as I mentioned earlier, digital services taxes and other relevant similar measures, which haven't yet been defined, have to be repealed. Now, so far on Pillar one, all we have is some draft rules on revenue sourcing and a little bit on the virtual nexus threshold. That was a 2-week consultation last month, plus another immediately following 2-week consultation on the tax-based determination for the amount A formula and scope determination, etc. Again, as I'll mention in a minute, it's based on financial statements, and that brings the accounting sort of expertise into focus in a way that for many of us in the tax law world has never been the case before. There are many, many more upcoming public consultations expected later this month and in April and May this year on all of the many issues that are thrown up by the design framework of particularly amount A, but also amount B and other aspects of Pillar one. I won't talk you through the list, but again, the US is nowhere near implementing anything that they would need to implement in order to follow through on their commitment to impose tax in the future on the basis of the amount A and amount B principles, as well as the Pillar two global minimum tax that we were talking about earlier. On the revenue and sourcing draft rules that came out last month, they appear to be extremely complicated. They would require companies in scope, which is probably, as I said, the largest and most profitable 100 or so multinationals in the world. They would have to basically keep a whole new set of books and implement new systems to gather information to try to trace revenue to the place of the ultimate customer, looking through the supply chain in a way that they do not currently have to do for any compliance purposes. So there's already some resistance to all the compliance costs that would be involved in this. Comments have been sent in. The OECD has already said they'll try to address the complexity issues and concerns in final rules. On the tax-based determination, this was a much shorter and apparently simpler consultation paper involving adjustments to the financial accounting profit, as you can see there, similar to the Pillar two rules, but Pillar two rules are entity by entity, whereas this is on a group-wide basis. So they're not exactly the same. And they've left some issues unresolved in the draft rules, such as putting a time limit on carry forward of losses and which losses from the past should be allowed to be carried forward. So it's the tax-based determination rules for Pillar 1 Amount A are still a work in progress.